Our telephone guest today on 15 Minutes of Fact would have to be considered a rare and controversial find from an Occupy Wall Street view, considering that this person is a veteran of banking, a trader, a salesman during the mortgage boom and the resulting mortgage crisis, which we now term the Great Recession, but one who lines up solidly with the Occupy movement when it comes to holding banking's feet to the fire for their misdeeds and outright thievery. I met William Frey, Bill Frey, when I attended an Occupy Alternative Banking Committee meeting this week and almost fell off my chair when they introduced him as a guest speaker. As an insider to the workings of hedge funds, investment banks, and the mortgage industry, having him address our group seemed almost like inviting the fox into the henhouse. That is, until he began to talk. So I think you're going to consider the next 15 minutes not only educational and helpful in achieving a balance of thought about the financial mess that we are in, along with some suggested resolutions, but you're going to find it entertaining as well. So welcome to the show today, Bill.
Thank you, Jerry. I'm happy to be here.
Very happy to have you here. Now let's begin this conversation by first getting to know a little bit about you and how it came to pass that you were invited to an Occupy working group on the banking industry to start with.
Well, it's sort of, it depends on how far back you want to go, but I first became public when I had an article written about me in the New York Times in 2008. And the article basically said that I had written a series of letters to banks and trustees that serviced assets that I controlled, and said that if you choose to use a new law that was just passed in Congress, that I would choose to sue them. It was really straightforward and quite factual. And when the New York Times wrote about this in October, the Financial Services Committee took exception to me wanting to exert my contract rights.
You're talking about Barney Frank's group.
Barney Frank's group, yes. And I got a letter from 6 representatives on the committee, basically asking me to come to Washington to explain my behavior.
I think you're being kind of polite. If I remember the wording of that letter, it says they were outraged that you were actively opposing their efforts. So, my goodness, what a nice letter to receive.
I'm being as polite as I can possibly be.
Don't bother on this show.
Well, that's the way I am. I will be polite to everybody, even when I dismember them with facts. So
and continue to do so.
Well, anyway, so I was asked to not testify once they understood that what I was really saying was that the secret to resolving this problem lay in the banks and the homeowners, that there were ways to resolve these conflicts that would mitigate the losses for the investors, which was my concern, and which is still my concern, and that the government did not have to empower the banks to do anything. And the reality is that the banks are conflicted in this matter, and the banks actually have an economic interest in perpetuating this problem.
Now, I'd like to stop you there and go over a couple of key points that you brought to our attention the other night at the group meeting. You said that it's sort of a false dichotomy, the idea that we're bailing out banks when actually the banks are perpetuating this myth, and if anyone is to be responsible for the losses by law and by contract, it should be the banks now. So go into a few details about that.
Okay, there's so many different tentacles to this problem. I'll start with a few. The first thing is that when the banks put these securitizations together, the assets that were placed in the trust that was sold to investors, and those investors, keep in mind, are very often American pension funds, college endowments, Fannie, Freddie, the Federal Home Loan Bank system, as well as individuals that have mutual funds and own bonds and things like that. When they put these transactions together, they did not accurately represent what was in the securitizations. And within the pooling and servicing agreement, there's provisions that require them to repurchase any loan that does not conform to the standards that they represented.
Which is a very key point, that they, in case there was something going south in the deal, they would be held financially responsible.
They would be held financially responsible if they misrepresented the deal.
I see.
The credit risk on these assets was indeed passed to the investors, provided it was accurately represented.
I got it.
So, for example, if it were an investor property that was represented as an owner-occupied property, that's a material misrepresentation, and they can and should be forced to repurchase that loan. So that's the first problem that the banks have. The second problem that the banks have is within their organization, they have an internal conflict of interest. So, for example, it's very often that banks own second liens or the junior liens or the home equity piece on a particular home, while the investors own the first lien. The investors would have been sold the first lien through the securitization process. Now, when the banks look to resolve a problem with a homeowner, they're required to take the first loss because they own the junior lien. Well, the banks have no desire to take that first loss, so they've been lobbying Congress to have Congress encourage them to modify loans. Encourage them to modify loans. Correct. Now, their idea of modifying loans is fixing the first lien by reducing it, which economically bails out the second lien. So, for example, if someone were to go into Countrywide 6-7 years ago and want to purchase a $500,000 home, they might very well get a $400,000, quote, first lien or senior obligation and a $100,000 much more expensive second lien. The bank would keep the $100,000 second lien and sell the $400,000 first lien. Now, the homeowner has not put any money down. So if the value of that property went to $400,000 and they were forced to foreclose, the bank would lose their entire $100,000. However, if they modify the first lien to refloat the homeowner and change that from $400,000 to $300,000, the first lien holder incorrectly takes a $100,000 loss, and the bank incorrectly takes zero loss. Well, you use the word incorrectly. What are you really telling me? What I'm really saying is that the banks have a tremendous amount of second lien assets on their balance sheet that are massively mismarked. The total that the four largest banks have, Wells Fargo, J.P. Morgan, B of A, and Citibank, amount to about $450 billion. And those are on the books close to 100 cents on the dollar. And the economic value of those assets amount to about 30 cents on the dollar. This is very painful to listen to. It's a very, very large number. And this is, in essence, the crux of the problem in resolving the mortgage crisis, because the government continuously looks to the bank to fix these loans, that they are merely a servicer or a paid helping hand on, and have not engaged the ultimate principals or the owners of the assets, which are the investors. Which is almost like saying, ignore that man behind the curtain. It's almost like saying if you don't like your neighbor's house, ask the cleaning lady if you can buy it. The cleaning lady does not own the house. The cleaning lady has no rights to that house. And the cleaning lady is merely there as a helping hand. Which now leads me to the poor pension fund holders, the owners. Why in the world were they allowing this to happen, or were they allowing it to happen? The pension funds like to buy fixed income assets, and especially like to buy long fixed income assets because they have very long liabilities to the pensioners. So if you're a 50-year-old school teacher and you're contributing to a pension fund, either directly or indirectly, then you don't want to buy 1 month paper You want to buy 20 and 30-year paper.
That makes sense.
So that you match the assets and the liabilities, so that you can better predict your cash flows for the school teacher when he or she indeed retires.
Well, as that school teacher, I'm also interested in the safety of that particular investment that my pension fund is doing. Who is responsible to see that the bank is maintaining their capacity?
Technically, it's the trustee, but the trustee is not, it's an indenture trustee, and an indenture trustee is not covered by the Trust Indenture Act, which means that the trustee will look at an investor or a pension fund right in the eyes and say, we as trustee are not legally a fiduciary, which is rather disturbing because I'm not sure what else a trustee is if they're not a fiduciary. It's sort of in the root word of trustee is that you're a person of trust. And they are absolutely refusing to act in a responsible manner, which is to mitigate the losses for the investors.
Do I understand that some of these trustees actually say, I won't even listen to you as an investor unless 25% of you and all that you have as assets come forward? Or am I misunderstanding this?
So there's a general provision in contracts, and it's to prevent greenmail. But the provision says that in order to speak to the trustee, you must have 25% of the outstanding bonds. Well, given that these are billion-dollar transactions and were sold to 10 or 20 different investors all over the world, and that the holdings are private, that's almost an insurmountable barrier to having a conversation with a trustee.
Okay, so I'm finding flaws all over the place. And I understand the problem with the trustees. I understand the problem with the pension funds. I understand the problems with the banks. What about the government? When the government stepped in and you said, and you were treated rather curtly by them, they said...
That's also a nice understatement.
Yes, to be pulled before a House subcommittee, and in the fashion that you were. So, what is it about you that attracted their attention? And as the saying goes, what's in it for you, Bill Frey, to become involved in this fiasco?
Well, the first thing that's in it for me is I happen to have been born here, and I happen to have worked with mortgage securitizations for the last 30 years. And I realize the value of this financial instrument to this country in attracting private capital to the mortgage market. And when the securitization model fails, it means that there is no private capital going into mortgages. So what we have right now is 98% of mortgages that are made in this country right now are done so with government backing. That does a number of things. One is it dumps an inordinate amount of risk into the government in Fannie, Freddie, and FHA. It also means that the underwriting standards are based on political considerations rather than economic considerations. And I don't believe that that's a good thing for this country.
So that is the other flaw that's outstanding. Now, I know from having read your book, and I want to provide that title to the listeners right now. You wrote a book called Way, that's capital W, capital A, capital Y, Way Too Big to Fail, How Government and Private Industry Can Build a Fail-Safe Mortgage System. And you wrote that book, I believe, as an outgrowth of the work that you had to do when you were answering people's questions, because there are a lot of questions that people are asking. So one of the foundations of the Occupy movement is this belief in the power of education, and by that, financial education as well, so that people might no longer find themselves victims when financial imbroglios come about. So I feel that your book, Way Too Big to Fail, fits into that category. So tell us about the book, how it came about, and why an Occupy person should read it.
Well, the title Way Too Big to Fail actually refers to the mortgage securitization market. And that market is almost as big as every bank in the country combined. So what the banking system historically has been viewed as a vehicle to intermediate credit from the private sector from the providers of credit to the consumers of credit. Well, part of that financial intermediation system is the securitization system. That has completely failed. Now, there were flaws in it, but if we do not understand that that is an integral part of this country's ability to intermediate from the savers to the consumers of capital, we have a problem. So the title Way Too Big to Fail goes to what is really important in this whole financial problem. And the government intentionally, and I would argue even correctly, saved the banks. We could not have a series of Lehman Brothers. That was unacceptable. However, a major hunk of the financial intermediation system was allowed to fail. And I don't even believe that the members of the government fully understood the importance of the securitization process.
Well, that became quite obvious, and I've been reading your book, and I can understand why we, as the public, need to be educated about this, and not react and respond to everybody who has a banking credential such as you. So let me address the sensationalist aspect of your relationship to the public at large, not only to Occupy, but to the Tea Party and libertarians. In our case, I believe there's a video on YouTube called Frying Frey, in which housing advocates apparently showed up on your front lawn. And I also know that you've spoken in front of libertarian groups and Tea Party groups. Did they treat you any better or any differently? So tell us about that experience and what we need to know from that.
Well, once people start understanding the internal conflicts of interest within the securitization system and realize that in order to fix the legacy mortgage problem in this country, we have to address those conflicts, and we have to address all of them. And the first thing you have to do to address a conflict is to understand it. And the folks that showed up on my front lawn really were pathetically ignorant of how securitization worked. They simply decided I was a bad person because I turned around and said I was going to sue the banks, and then promptly turned around and sued them for the act of not handling the mortgages appropriately.
And how did they misunderstand this?
Personally, I think the cord was wrapped around some of the folks' neck when they were born.
Okay.
I don't think they made any effort to figure out what I was saying.
Well,
the information I had was all in the public domain, and if they simply read a few of my letters that were available publicly, they would have been there offering to, rake my leaves and cook me breakfast because I was helping them.
I wanted to remark on that because you would not have been invited to the committee meeting if people did not respect your credentials and also felt that you had something to teach them. So did you find a better reception on the part of a Tea Party person as opposed to the unbenighted few here in the Occupy movement?
Well, I don't really think that it matters whether I'm talking to someone from the right or someone from the left. Once they understand the internal conflicts of interest, and once they understand the facts, it doesn't matter what your political leanings are. So I'm not fighting the right or the left, I'm fighting ignorance. And the ignorance happens to be mainly in the center.
Well, Bill, I want you to know that this 15 minutes has slid by just dramatically, wonderfully. And I know that we're going to be doing a series of 50 Minutes of Fact with you because you've got some solutions in your book which I think need to get out into the public domain by way of the Occupy people, by way of Twitter, and by way of Facebook, by way of LinkedIn. So I'm going to thank you for appearing today, and I'm also going to advise the listeners that they can reach you. Do you want to provide your email address, Bill?
Sure. They can hit the contact button at waytoobigtofail.com.
Well, you're also on Twitter, by the way, as WTBTF, which is Way Too Big to Fail. And you have a Facebook page with that moniker as well.
Yes. And we certainly encourage your listeners to contact us, and we do respond. And if they perchance buy the book and read it, I certainly would love that if they post comments, good or bad, on Amazon. And if they want to email me and debate parts of it, I'm perfectly willing to respond to those.
Well, that you are, and I want to thank you so much for being on the show today. I know you'll be on some future ones as well. So this is Jerry Ashton with 15 Minutes to Fact, our way in the Occupied movement of being able to put out for the listener all points of view about Occupy, how it came about, what it's doing, what it needs to do, and where it's headed. So once again, Jerry Ashton signing off for 15 Minutes of Fact on WGRNradio.com.